China is virtually in deflation. Now is the time to look at how long deflation will last. Deflation is the opposite of inflation, as it is a continuous decline in the price level. It is accompanied by stagnant business activity, increased bankruptcies, and reduced production, followed by an increase in the number of unemployed. China's economic growth rate in the second quarter of this year was 6.3% year-on-year, higher than the first quarter, 4.5%, but falling far short of the market forecast, 7.1%, with the growth rate falling short of expectations and consumer price inflation in July turning negative for the first time in 2 years and 5 months. There are concerns that the Chinese economy could fall into a trap of Japanese-style deflation. China's July consumer price inflation turned negative for the first time in 2 years and 5 months. The National Bureau of Statistics of China announced on August 9th that the consumer price index in July fell 0.3% compared to the same period last year. It is the first time since February 2021, minus 0.2% during the COVID-19 pandemic, that the CPI recorded negative compared to the same month last year. The producer price index, a leading indicator of the CPI, fell 4.4% year-on-year, continuing its downward trend for 10 consecutive months. The decline was larger than Reuters' estimate, minus 4.1%. It is the first time since November 2020 that both the CPI and the PPI went negative simultaneously. Unlike the temporary drop in prices, the recent drops in prices is a phenomenon caused by a combination of slowdown in global demand and sluggish domestic demand. As local governments are sitting in a pile of debt, fiscal expansion policies are also limited. On this day, the authorities announced the urban unemployment rate 5.3% for July, and the unemployment rate by age group, including the youth unemployment rate, was exceptionally kept private. The youth unemployment rate in China, aged 16 to 24, hit a record high of 21.3% in June. There are speculations that the youth unemployment rate in July, when college graduates entered the job market, increased more than the previous month, so it was not disclosed. In response, the People's Bank of China cut the 1-year medium-term liquidity support windows MLF loan rate, which is the short-term policy rate, by 0.15 percentage points from to 0.65% to 2.50% per annum to supply liquidity. Earlier this year, the Chinese economy was expected to serve as a growth engine for the global economy. This is because, unlike the United States, which is implementing an intense austerity policy, China's People's Bank of China continues its monetary easing policy, and the zero corona policy ended at the end of last year. It was the general expectations of experts that the Chinese economy would show a strong growth trend as the demand that had been suppressed during the zero corona period erupted. But these expectations was misplaced. It is pointed out that the Chinese economy could fall into a vicious circle in which consumption shrinks due to the negative asset effect caused by falling real estate price, which reduces corporate investment and in turn reduces jobs. The fact that Chinese companies are competitively lowering product prices when consumption has not picked up after the reopening is also adding the downward pressure on prices. Experts who predicted the rebound in the stock market in the second half of the year are also warning that the recent crises from China and the US are highly likely to spread to Korea. This means that the pressure of depreciation of the won will increase and credit risks centered on household debt may increase. The possibility of domino default of real estate developers, including bigger UN, Country Garden, and the failure of real estate trust companies to repay products are also raising fears in the market. Cumulative fixed assets investment from January to July increased only 3.4% year-on-year. This was mainly due to the decrease in investment in the real estate sector in China. As real estate developers fell into the crisis of default, there are concerns that fixed assets investment will deteriorate further in the future. The mood of the global stock market is also showing a reversal as various unfavorable factors such as the downgrading of the credit ratings of the U.S. government and banks, U.S. measures to restrict investment in China, and sluggish Chinese indicators have appeared. In August, 40 out of 47 countries around the world recorded negative returns. In the meantime, the fact that the global stock market has risen rapidly also increases the sensitivity to bad news. At the beginning of August, the 3-month return of the ACWI index reached plus 9.4% level at which pace adjustments were seen in most cases. Rising oil prices due to the Saudi-led production cuts, cost inflation expectations, and rising treasury yields in the U.S. As a result, the strengthening dollar is leading to a reduction in exposure to emerging market assets. Foreign investors are selling off major Asian stock markets. The Japanese stock market, where supply and demand have been concentrated so far, also switched to net selling in August. During July and August, foreign net sales on the Taiwanese stock market amounted to US $5.4 billion, a level that differs from that of Korea, minus US $940 million, which has a similar economic and industrial structure.